Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter like we normally do, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's going to be related to three topics: wealth building, commodities, and or financial topics. So let's dive in. Let's see what people are talking about, and I will interject my financial opinions. If you want to follow me, it's at @finding_finance. And if you want to join our community where we talk about individual companies, individual sectors, finding-value.com. We have a 5 p.m. Mountain Standard Time Sunday question and answer session coming for members. If you want to join, the discount code is holidays. So Jeff Winniger, however you pronounce his name. So 1990 through 2000, tech stocks; 2000 to 2008, energy stocks; 2008 to 2020, again, tech stocks; and 2020 through 2030, probably going to be energy beating tech stocks is my guess coming up. I even think that we could see a decline in some of these other sectors here. So I think we could see a decline in tech stocks, and I think we'll see a move up in the energy stocks. Now, you can see this kind of fractal here. The fractal is this repeating pattern and kind of a downward move there. I think this could be similar to this here. So we could be right before what potentially could be a pretty big move. Now, you could say that this bottom here, that fractal is this fractal there. Difficult to say because this fractal also looks like this one here. But I think we're close to a big move in energy and a lot of these different commodities. And I think energy will definitely outperform tech. Tech is vastly, how expensive it is. It is vastly overvalued in relationship to other asset classes. So this chart, as Javier Blas shows, that despite ample oil supply in the near term, we are in a period of relative scarcity. Oversupply is because of weak demand, despite the sound and fury from OPEC, IEA, etc. And it's not because of energy transition, it's a weak economy, duh. So global crude and condensate in floating storage, you can see this thing decline since 2020 quite ferociously. Ferociously is a great word, guys. You need to start using it. Q Infinity says, been saying this all year. Everyone thinks lower rates will make housing boom. No, it's just going to put more houses on the MLS because people stuck in 3% mortgages will finally be able to sell and be able to afford to buy something else. I don't think so. I totally disagree. What generally occurs is when someone sells a house, they need to then buy another house. So as mortgage rates go down, your demand of buyers goes up. It's going to put the housing market into a shortage. The only thing that was holding house prices down was the volume of sales, and the volume of sales went down because your first-time home buyers can't afford to buy their house, their first house. So if you lower rates, you're going to open up the amount of demand or the amount of buyers that are able to afford homes, which then puts the housing market back into a shortage because the price will be too low, which means the house prices will go up to balance out the affordability that was gained through the interest rates. So that is my take on it. And I think eventually, if the home builders build all the homes, that housing could go into a hypersupply phase, but we are not there yet. So I disagree with both of these people's takes in the short to medium term. It says, an image is worth 1,000 words, uranium for the win. Now, here's the way that I look at it. Okay, so I know uranium circumstance, it's up 70%, and it's probably going to go up a lot more. But generally speaking, where I would want to look right now is thermal coal and palladium. Those are the two that I would be buying when looking at this chart, because I want to go into stuff that's down. I don't want to go into stuff that's up necessarily. I'm already in the stuff that's up. I want the stuff that's down. That's where your opportunity is at. And especially if it is bottoming, where we get chart patterns, it's up against support levels, et cetera, et cetera. And guess what? Thermal coal and palladium are up against support levels. So don't chase price performance, especially the 1 year price performance. Do opposite of what almost everyone says. Now, I'm not saying uranium is going to go down. That's not what I'm saying. But I would be chasing some that might be down here, because that's where your value is best created, is that big pullback that you get. I buy pullbacks. I don't buy and chase price performance. The first bull run for gold ran from 71 to 1980, where price rallied from $35 to $800 an ounce. It's a 2,200% gain. The second bull run went from 99 to 2011. It rallied from 250 to 1900, which is a 670% gain. The third bull market could take gold to $15,000 an ounce by 2026 if the model holds. Now, here's the thing. I actually agree with this time frame, because when the yield curve uninverts, that's generally where gold goes crazy, and it accounts for the money supply that has been created. And we created a lot of money. So when the money rotates, it'll rotate back into gold during this market condition. Now, is it going to be $15,000 an ounce by 2026? I think the time frame's right. I don't know about the price. I don't know if it's going to be 15 or 8 or 10 or 6. I don't know. But all I can tell you is gold, I think, is going to do a third bull market leg, and it could be gigantic. And I think by 2026 could be a pretty good general area of time frame. WTI realist, the euro poor mind could not comprehend. So I wanted to talk about this. Look at this, these overpasses and stuff. When I would travel to Texas, I would see a ton of these types of interchanges here. They all look just massive. And I was coming up to one interchange and I was just in awe of how big it was. And I was at the bottom of one of these, and there was like 3, 4, 5 levels high, and it was gigantic. I think I saw a one that goes over like this that went for probably over a mile in length almost. Because I was like, man, that starts from way over there and it goes all the way across everything, comes and spins around and connects. And I was like, God, that's got to be at least a half mile or maybe even a mile, depending on where that thing actually hits the ground. These interchanges, some of them in Texas when I was there, I think they were hundreds of millions of dollars to build. I would imagine. Just massive. So Jeff, another one from Jeff, he says, over the last 10 years, stocks with the highest price earnings ratios have beaten stocks with the lowest price to earnings ratios by 2.2% per year. Before this cycle, the prior record was set in the year 2000, the peak of the dot-com bubble. So whenever we see the 10-year annualized outperformance of high PE stocks versus low, they've almost always indicated bubble type tops. And I think there's a pretty cool chart here. So I think that we're going to see a underperformance of high PE stocks in relationship to low PE stocks. And we are, at least I am positioned in low PE stocks right now, value. I think we're going to head lower. I think we are going to head much, much lower in this ratio here. Kaboom! Spot uranium has surged to a new 16-year high, with nuclear fuel brokers reporting a plus $1 jump to $86.47 a pound, with sellers asking an incredible $88. Uranium markets rose $1 to board the U train, with Evo markets at $86 a pound. Look at this. Look at this chart here, guys. Just look at that thing. It is moving up. It's not like we didn't know this was going to occur. Everyone who's been long the uranium spot, the uranium trade is what I'll call it. We all know that the uranium price is going to go up. Now the question is how high, and when are you going to sell? I think there's still a lot more to go in this. I don't think any of the problems have been solved, and being patient is where I'm going to be. This is uranium versus Ethereum. Very much on the path with Ethereum. This is where fun begins, in my humble opinion, especially for the mid caps. Juniors will explode in the next leg up, in my humble opinion, the third and final leg. So this is the uranium price. You can see this thing ready to rip. That's the futures price with Ethereum overlaid on top of it. The peak is somewhere in the mid to late 2020s. I know somebody was saying, well, what does Ethereum have to do with uranium? Well, I can tell you, humans trade both of these assets. And humans are the determination of the fractal. That's what determines that fractal. So if the fractal is determined by humans and humans trades Ethereum and they also trade uranium, this is generally the price movement that is likely to occur. So that's what we've got there. And of course, I lost. Okay, so coming back down, we were at Ethereum there. We are pleased to announce that the mining license for our flagship Etango uranium project in Namibia has been granted. A milestone event, as our project is now fully permitted and shovel ready. Read the full announcements here for Bannerman Energy. Get ready and hold on to your Bannerman shares. We're going higher, baby. Well, hopefully. I used to call this 10 Baggerman, but that's I've already surpassed that. I think I've surpassed it in the account, 10 bag. So now we got to call it something else, maybe 20 Baggerman or 30 Baggerman or something. S&P 500, the S&P 500 is poised to have its 7th consecutive green week, its longest winning streak since 2017. Whenever I look at this, this is what I see. I see a shoulder. This is like that Batman pattern, another shoulder, and I think this was going to roll over. And I think they saved it in 2022. Liquidity injections, lowering of the interest rate. They're doing everything they can to blow this thing back up. So it's going to be interesting. They don't want the money to rotate into commodities. I think they're going to try to hold gold down too. I don't know how they're going to do it. I don't think they're going to be successful. I think this is all going to blow up on their hands, they being the Federal Reserve. What a great 12 years it has been, destroying the housing bubble, boys. We are all anti-central bank people, and thank you all for playing. Still to this day, they don't get it. It's never going to be 2008, kids. And we're not going to get that. We're going to get a lowering of interest rates. We can see that the home builders continue to go higher. I agree with them. We are in a shortage. Sorry, guys. JP Morgan, top energy strategist. He says, we won't see oil demand peak in our lifetime. That's because there's a huge hidden demand from emerging markets. Everyone is so focused on the United States and how many electric vehicles we sell here. I hate to break it to you, but oil demand, I think it's something like 40% comes from transportation. And then you have a small sliver of that 40% coming from just the United States. The demand from emerging markets is going to be massive, and we're going to suck and use every single drop of oil that we can get. I don't think people understand that. And you can look at catalytic converters that are projected out in the future. It's not like these people are going to be buying electric vehicles with no grid. They're going to be buying hybrids, or they're going to be buying ICE engines. Now, I'm not saying internal combustion engines are going to go up in sales worldwide forever. What I'm just saying is you're not going to be driving an electric vehicle with no charging stations in Africa, or no charging stations in some of these other emerging markets. Global observed oil inventories declined by 19.6 million barrels in October, according to the IEA. Surfacing this again now that rates are back under 7%. It says mortgage rates moving from 7 to 8% since July means around 5 million fewer households would qualify for $400,000 mortgage. The potential borrower pool has now shrunk by minus 56% since 2021 rates are 3%. Now keep in mind, this is going to reverse backwards. So what I said earlier, there's a larger demand of first-time homebuyers as interest rates go down. As interest rates went from 7 to 8%, 5 million fewer households would qualify. But now we're back in the sixes. So now greater than 5 million households are now coming back into the market. based off of the interest rates. So this is households who can qualify for a $400,000 mortgage. At 3%, 50 million households would qualify for a $400,000 mortgage. At 7%, it's 27 million. 8%, it's 22 million. Now, what if we get back to like 5%? That is a large amount of people who are going to now be able to qualify for a $400,000 mortgage. So that is the tipping point here is your demand is dictated here by the interest rate, and it's never been more sensitive in history to that. No way they can raise rates to 20% to break gold this time. It says you can mathematically raise rates up to 15% on a rapidly growing U.S. national debt of $34 trillion. The debt is adding another $1 trillion every 2 to 5 months at the current pace. Tax revenues don't cover this type of spending from both parties in D.C. It's a math problem. So people are starting to wonder if gold takes off, how are they going to break it if your inflation rates go way up? And they can't raise the interest rates to a level that may be needed. They're thinking, 1980, 20%, 15% interest rate to break gold. What are they going to do this time? Just let it run? I don't know. Physical gold and silver are key. Everyone should own some physical precious metals. So Gary says, as we've seen, heavy manipulation of the metals market creates swings that are too large for most traders to mentally survive. They get caught in an attack. Emotions kick in and they end up selling at the bottom of the pullback. Just look at some of the comments over the last 7 days. This is why I keep stressing physical gold and silver. You won't make these emotional mistakes if you're holding physical. The banking cartel won't be able to fleece you and knock you out of your positions. Silver is swinging violently back and forth. It's a sign of manipulation is in the process of breaking, but it's going to be a rough ride until it does. Here we go, boys. Let's get it. 1999, at least it had dips in 99. Right now, 2023 is just upward. Up, 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 up for the S&P 500. Here's uranium divided by SILJ. So silver miners might outperform uranium miners for a while at least. Is this a head and shoulders type breakdown that we're occurring that we could see pull back for a period of time? It's possible. It's possible. Now, I'm not betting on that, but it is possible. The chart's kind of shown us that. We got the US dollar purchasing power now below its continuation breakdown line. 2 weeks left before monthly close. This looks interesting here, guys. Notice that the gold chart, if you were to flip this over, basically flip it over the continuation breakout line, you flip it, it's the dollar breaking down. And we can see that we just went below a breakout line for the US dollar, which means we are about to rip on the gold monthly price. So gold's ready to rip higher here as the dollar breaks down. You can say that about a lot of different commodities as well. I think that the commodity complex with the dollar breaking down is going to be very interesting for commodities coming up. Here's Grady. The inflationary 1970s caused a huge rise in gold. When called the commodities bear market low back in April 2020, also said we're in for big inflation. I think it is time for the next historical inflationary wave. Yes, a clearly wild chart, but quite likely. So let's read through some of this on gold. He says the inflationary 1970s, it went up 2,400%. We had the second bull phase here, and we are ready to break and do another third bull phase, much like the first bull phase. What this kind of means, so it says the largest, very probable bullish rising wedge continuation halfway pattern I have ever seen. It says this wild chart does say target is $48,000 an ounce, which would be the approximate number if the USD M2 money supply was backed 100%. What do you guys think of that? What do you guys think of that? Do you think that is possible that we could hit $48,000 and that this projected move is what could potentially occur moving up? I actually think it's possible. This doesn't mean anything about gold. It means everything about the dollar here and how this is about to break lower, and that's going to be the fuel for this to go up. A very large inflationary period could be coming right in front of us. Are you positioned for it? Put in the comments section if you're positioned for this large inflationary move. Tavi says, call me crazy, but I believe we're in the process of forming a major double top in the Nasdaq. Hey, that's similar to what I think. Valuations don't grow to the sky, and the inflation problem is far from over. Today's weakness in mega caps, despite the Fed pivot, is the tell. Now, here's one thing I will say. I think he is right, but here's the big but and why I would not short it. The big but is if this is coming, the inflationary 2020s, if this is coming and the dollar breaks down, there is a possibility that this goes up and doesn't stop. It's not the Nasdaq will lose value against other assets, but it doesn't mean it will lose value against the dollar in a very inflationary time frame. So that is what I'll say there. He's right, but he could be wrong on it coming back lower. It's just that it will lose value against other assets. It says lower rates will set U.S. fire. Will set U.S. housing on fire, and I think we've touched on that before. So I'm going to end it there, guys. That's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Don't forget about the 5 p.m. Mountain Standard Time meeting on Sunday if you guys want to ask questions directly to me and you're part of the community. So that's what I've got. Looks like everything's still A-okay for commodities, and data still looks good. So we'll catch you later. This is Finding Value.